Thank you for joining us today. We're excited to host a conversation that explores one of the most talked about areas of the investment landscape right now, precious metals. Troy Lucas is a financial representative with Opus One Wealth Strategies. And since 2018, he has been sharing insights around the potential opportunities within precious metal market. During that time, silver has risen more than 400% and gold more than 300%, making this a fascinating moment to step back and evaluate where things may go next. So excited to be here. So excited to be talking with you, Troy and Chelsea. Very riveting conversations here that we're going to go into. Some of them have to do with right now, what's going on in the world as well. But kind of what we're going to be going through, I want to lay the land here before we get started. We're going to talk about what first caught Troy's attention with precious metals years ago, where he believes the market stands today, other sectors of the market they may present opportunities, the Iran war and its effect on the market, and how everyday investors should think about wealth over time. So the first thing I want to ask is going to be, where do you see precious metals market now and in the future? What even made you think about this, first?
Great. Well, thanks for hosting this discussion. I think it'll be very interesting. What got me interested in precious metals and where I saw an opportunity years ago is really based on my experience with economics. My degree's in economics. I've always nerded out on economics. Even when I was a teenager, I would read economics books, Economics in One Lesson by Henry Hazlitt, Human Action by Ludwig von Mises, and other such works. What really gets me most excited, in fact, about economics is monetary economics. And in order to understand gold in particular, you have to understand money in and of itself. Gold has been the money for all of humanity for thousands of years, and that has been its primary purpose. So we actually live in a very unique time, in a very odd time, where gold is not currently the money. We are on a dollar standard. We're on a fiat standard, which is very strange, historically speaking. And of course, that has a lot of implications. We have been on the system essentially since 1944 with Bretton Woods, but really since 1971. In 1971, President Richard Nixon took us officially off the gold standard. And what that means is, before, a central bank, the French central bank, for example, could go to the US central bank and say, hey, we want our gold, right? And the dollar was pegged to gold at a certain price, around $35 an ounce. So the French could go to a US central bank and plop $35 on the counter, and they would get an ounce of gold. That is really what backed up the dollar. In 1944, and I know this seems very academic and whatever, but it's really not. It has everything to do with what's going on. If you want to understand the gold trade, you have to understand this history. In 1944, prior to that, the economy ran on a gold standard. Gold was the money. In 1944, of course, World War II is happening, and essentially the United States won World War II in a spectacular fashion, because the whole world basically destroyed itself. And the only economy that didn't destroy itself was the United States. During the war, of course, the United States was the primary supplier of weapons, oil, agricultural products. In fact, it was really due to the United States that, for example, the Soviet Union didn't starve to death during World War II. That's how much Lend-Lease the United States provided to the Soviet Union. And of course, since it was wartime, the surest way to receive payments for all these goods was to receive it in gold. And so what ended up happening is Great Britain, the Soviet Union, and other economies paid the United States their gold in order to receive weaponry and oil and food, etc. And the United States eventually had something like 70% of the world's gold reserves towards the end of World War II. And so the United States very smartly told the world, hey, we have the gold anyway. just use the dollar as your reserve assets. It's as good as gold. We have the gold anyway, right? So in other words, if you have a dollar, it's basically the same thing as having gold. And of course, the world, unfortunately for them, decided to agree to this new arrangement. The dollar became the world's reserve currency. But of course, 1971 comes along, and the United States essentially, for all intents and purposes, stole the world's gold, ended the redeemability of gold and dollars. And since then, since 1971, we've been on a fiat standard where everything is priced in dollars. But there's a big issue with that. And the issue is, of course, that what makes gold such a good money is that you can't really inflate it. And here we get to, a very important point, which is, what is inflation? Today, we understand inflation to mean increasing prices. But that's not really historically what inflation means. Inflation, particularly prior to the 1980s, if you read some old dictionaries, inflation was always understood to be an expansion of the money supply, which results in an increase in prices. Okay, so what has happened is, since, with gold, you can't really inflate gold that much. There's only so much of it you can mine. It's very difficult and expensive to mine it. So the supply of gold remains pretty constant throughout time, all things being equal. And so general price rises are not really, you don't see large price rises in a gold regime, so to speak. And we have hard data on that. If you look at price levels from the beginning of the American Republic to basically the creation of the Federal Reserve to 1920, prices consistently went down. So in other words, our great-grandparents, today we're used to a scenario where prices are always increasing year after year. We go to the grocery store and we have to pay more. But our great-great-grandparents would have had the exact opposite experience. Every year they would have went to, the market or wherever they bought their groceries. They would have seen prices declining year after year. Things would be getting cheaper year after year. And again, that's all because of the monetary regime that we have. Now, what does this have to do with gold and investments? Well, what gold does, and I have a graph here to kind of show this, is gold is a monetary metal. That's what it is. And if we look historically, basically from 1918 to now, we will, and I chose that year because, of course, in 1920, we get the Federal Reserve, and they start to engage and facilitate credit expansion, which then causes a revaluation goal. But the real important part is, especially once we hit 1944 in Bretton Woods, and especially 1971 with the official break from the gold standard and between gold and the US dollar, what we see is very interesting. And what we see is that gold, historically, it lags. This green line you can see here is M2 money creation. Well, all that means is the money supply. AKA the dollar supply. Okay, so this green line going up is the amount of currency in circulation. And what we see happens is gold lags behind currency creation and then spikes. Because gold has to revalue to account for all the inflation in dollars. Because fundamentally, again, what is gold? Gold is a monetary asset. That's what it is. And so, for example, in 1980, gold spiked and basically caught up to the amount of inflation, real inflation, dollar inflation, right, that had been created up till then. And of course, the reason that happened is because in 1971, we abandoned the gold standard. And then we had the 70s, which was the period of stagflation, which resulted in a 75% loss in the dollar's purchasing power in the 1970s. So in just a few years, we had, the 1970s really were a terrible time for the dollar. And so gold reacted violently. And the reason it reacted violently is because investors started flocking to gold to protect their purchasing power. Because ultimately, the market figures out that gold is the real money. That's what happens. But it's camouflaged by the fact that we have to use the US dollar in taxes and whatnot. And so, the government forces us to use the dollar, but real economics will always rear its head, and the real money will always bubble to the surface, which is gold. And so what is the investment thesis? Well, the investment thesis is, as long as the government is engaged in inflation and creating more dollars, gold must tend towards rectifying that inflation. It must tend towards matching that dollar inflation, like we see in 1980. Now, in 2018, when I was talking about gold, and gold was at $1,400 an ounce, of course, I thought that was an absurd price. I mean, that was an absurdly low price. The market was bound to correct up. And of course, that's obviously what has happened. Now, here we are with gold near $5,000 an ounce. And here's the real kicker, I think, of the whole thing. And that is, if gold were to repeat what it did in 1980, gold would have to get up around $22,000 an ounce.
Wow.
So just to account for the amount of inflation that has been created until now, gold would have to get to 22,000 to match that, which is a pretty incredible number. And furthermore, gold has another interesting aspect to it, and I'll go to another graph here to kind of show this, is central bank reserves, okay? And this kind of lends a little bit more evidence to what I'm talking about. Traditionally, especially since the Bretton Woods system, US dollars have and to be more precise, US treasuries, US treasury bonds have made up the vast majority of reserves of central banks. If you go to the Eurobank, the ECB, or the Chinese central bank, a lot of their reserves, most of their reserves, are going to be in US treasuries, US dollars, essentially, to make it simple. But what we have seen since 2000 is that central banks are gobbling up gold at a record pace. And in fact, it now is the case that gold is the number 2 asset backing up reserves in central banks. It used to be the euro. It is now gold. And you can see the trend increasing. And of course, the reason that this is happening is because central banks and markets are losing faith in the dollar for a multitude of reasons. One is, of course, pretty obvious to most people, which is the incredible amounts of budget deficits that the government has, and just the number of outstanding debt. Currently, our deficits are around 6% of GDP, which is a phenomenally high figure. We are currently generating the largest peacetime budget deficit in history. So in other words, the only times the government has been in such a steep fiscal deficit is in war, particularly the First World War, Second World War. So the government is engaging in a massive amount of deficit spending, which of course is bad news for the value of the dollar. And furthermore, and arguably even more damaging, is what happened in the Russian-Ukraine war. The reason it has been incredibly damaging is because the United States and Europe essentially confiscated $300 billion of Russian-owned US treasuries. Now, why is that such an issue? Well, the issue is, if you're a central bank, particularly a central bank that is somewhat adversarial to the United States, like China, Russia, Venezuela, then what that means is the United States, if they don't like you, can simply confiscate your reserves, which is quite an issue, to put it lightly. And so if you're China or you're Russia and your US denominated reserves just got confiscated and can get confiscated at the click of a button through the SWIFT system, then you're going to start looking for other assets to back up your currency. And that's exactly what Russia and China are doing. And not just those countries, but many other countries. The biggest buyers currently of gold are central banks. And again, why does this matter? It matters because central banks don't really care about the price that they buy gold at. Central banks aren't really in it to make a profit on gold, like you and I would invest in gold. You and I would invest in gold because we hope to sell it for a 100, 200, 300% profit in the future. It's not really how central banks look at it. It's more about percent allocation to reserve assets. That's what they care about, and it doesn't really matter the price. So what does that mean for gold investors? Well, what that means is we have a dollar that is losing popularity. We have central banks that are buying gold at a record pace. And since they don't care about the price, what it essentially does is put a sort of floor on the price. And we kind of saw this. Gold recently sold off pretty substantially. It had gotten up to around 5,100 an ounce, and then it had a substantial correction down to around 4,400 an ounce. But has since recovered. I mean, it recovered in the space of 1-2 weeks. And what that tells you is there's a lot of demand on the sidelines ready to gobble up gold. And if you compare that again with the amount of monetary inflation that gold has to catch up to, that roughly 22,000 an ounce number, there's a pretty compelling case to be made, I would say, that in the risk reward ratio of investing in gold, it's still very much skewed to the reward side. So that's kind of the overall look on gold. Now, silver is a little bit of a different animal because gold is mainly a monetary asset and it has some secondary uses as in manufacturing. Some gold is used in electronics, obviously jewelry, we all know that, dentistry. All right, so there are, but those industrial uses are very much secondary to its monetary nature. Silver is the exact opposite. Silver is mainly an industrial metal with a monetary component, because silver has also, along with gold, always been money in the past in human civilization. So, and not to mention, silver is a much smaller market than gold. I mean, it's like a tenth of what the gold market is. So silver is a very small market. And the reason it's important to note that silver is a small market is small oftentimes means more volatile. Okay. So as a general rule of thumb, not always the case, but as a general rule of thumb, if you're someone who's a little bit more conservative, you would want to look at something a little bit more like gold. If you're someone who is a bit more speculative, who likes more risk, then silver might well be your market. But these are kind of the dynamics. And I'll show another graph here talking about the gold and silver ratio to kind of, because now I've been talking about where gold is going to tend to go. And by the way, just a side note on gold, which is obviously that $22,000 an ounce kind of target I'm talking about. Gold's not going to go there in a straight line. So like with any investment, like with any asset, of course, there's going to be volatility. There's going to be pullbacks. There's going to be bear markets. That's just the nature of the beast, right? So for example, at our firm in Opus One, one of the things we are always going to talk to clients about is suitability. Right? Not all investments are suitable for everybody. If you are somebody who can't sleep at night because your portfolio is down 2%, well, then, something like silver may not be right for you, right? It may be a little too volatile for you. So of course there needs to be suitability included in any discussion. But going back to the subject at hand, when we look at silver is generally going to go up if gold goes up. Like I said, silver is an industrial metal, but it has that monetary component. If gold's going to go up, silver's going to go up. it's just going to go up a little bit differently. And right here, I have a graph of the gold and silver ratio. And when I was talking about particularly silver, so, back in 2018, 2019, and even up until very recently, what I was pounding my fist on the table about was silver, because if you see at the time, silver was very much cheap. I mean, the gold silver ratio was so high, meaning you could buy around 80 to 90 ounces of silver for every ounce of gold. So with 1 ounce of gold, you could buy 80 to 90 ounces of silver, which is historically a crazy number. I mean, that's a crazy number. I mean, if you look at all history, that ratio tends towards 15 to 1. You can typically buy, historically speaking, 15 ounces of silver for every 1 ounce of gold. So to have it at 80 or 90 is a pretty insane number. And it was evidently insane to me at the time, which is why I was pounding my fist on the table about silver in particular, which ended up working out. It has gone up even more explosively than gold. Now, as we're talking today, silver is a little bit more dangerous, because as you can see on this graph, that has almost completely shifted. I still think it's historically somewhat high, being around a 40 to 1 ratio, but it's not as clear cut as it once was several years ago. And so silver investors in particular, if silver is something that you would be interested in, it's a little bit more tricky at this time to invest in as compared to gold. Now, there is a slightly separate discussion to be made, which is, I've been talking just about the commodity, right? Just about the money, gold and silver. But there's also an investment ecosystem around that is somewhat interesting, and those are gold and silver mining stocks and gold and silver, what are called streamers. Now, for someone who is looking to get into gold and silver, but wants a little bit more of a leveraged play, wants a little bit more volatility, someone who's a little bit more open to risk, such that, if gold goes up 50% and they want an asset that is correlated to that, but could potentially get 100 or 200%, well, then you might want to look into gold and silver mining stocks or gold and silver streamers. And I'll just make a very brief point on those so that we can move on to some other subjects. But mining stocks, those equities of the companies who do mine gold and silver, those are very, very much, those are a riskier endeavor, because of course with mining, yes, a miner will typically go up if the price of gold goes up, because obviously now they're selling their product for a much higher price. But it is a little bit more complex in the sense that you have operating, it's a business, right? You have operating costs, you have salaries, you have capex, capital expenditures that you need to have. So costs also go up. However, since they are equities, you can tend to get a more leveraged play out of those mining stocks. And so if if anyone watching this were to wonder about some of those things, those are some equities that we can discuss, right? And I'm not sure we have time to get into a bunch of those, but definitely that is something where we can have kind of a meeting and discuss some of those equities and what that looks like. There's also streamers, and I'll just briefly touch on what a streamer is, because almost nobody knows what they are. I mean, gold and silver mining stocks, people can wrap their head around that pretty easily, but almost nobody outside the space knows what streamers are, but they're arguably an even better opportunity. And streaming companies, what they are is they will they work with mining companies to essentially buy future production at a low price. So if I'm a streamer, I'll go to a gold mining company and I'll say, hey, I will buy a certain percentage of your gold output this year at $2,000 an ounce, let's say. Okay. And it's good for the gold miner. And then typically what the streamer will do on top of that is they will pay that money up front oftentimes. Okay. So I'll buy, 1,000 ounces at $2,000 an ounce right now. today, and I'll just give you all the money up front. It's a form of financing, essentially, is what it is.
That happens in oil too, right?
Yes, and all commodities.
Yeah.
In all commodities, it happens. And these streamers are very popular because you get all the upside of the gold price. So if I bought it at $2,000 an ounce and now it's selling at 5,000, well, now I'm making a killing profit-wise, of course. But I don't have to deal with any of the downsides of running a mining company. A streamer doesn't have to make capital expenditures. It doesn't have to hire people. It doesn't have to deal with governments, taking long on approving future license on production. All the kind of stuff that miners typically have to deal with. A streamer doesn't, which is why their streams of revenue are usually valued at around 15 to 20 times the earnings, whereas a miner's cash flow will be valued at around 6, 7, 8 times. So streamers are also a very interesting opportunity to just capture some of the volatility in the gold price. And again, if anyone were to be interested kind of in some of those more specific cases, it would definitely be worth your while to sit down with me and have a discussion on that. But that's kind of that's a long answer to your question, I realize. But
no, but it was very, very interesting. And, that makes me think, okay, so you're saying, the silver to gold ratio is a little, more scary at this point. And well, where do you see the precious metals like right now and as we go forward, like in the future?
Well, that's a great question. And it's a tricky question. In 2018, 2019, 2020, I don't think it was tricky at all. I mean, it was pretty much, this is pretty much as low as it's going to go because it was absurdly low. Like I said, now it's a little trickier. My outlook, of course, is long-term bullish. I expect, like I said, the current, so to speak, equilibrium price for gold, I would argue, and I have argued in this interview, is closer to around 22,000. Currently, it's at 5,000. So I think there's absolutely that impulse to drive the price higher. What is tricky about what's going on right this second is short term, and of course, always in investments, the short term is the most difficult to predict, which is why typically what we're going to recommend, like at Opus One, for example, is that typically don't try and time the market. Just be in, stick to your investment strategy, and just be in, because it's very tough to time the market. The difficulty with silver in particular is, since silver has exploded so quickly, is it's always in the strongest bull markets that you get the strongest corrections. Right.
Mm-hmm. Yeah.
And really what those are made to do are to shake out the speculators. Right. So, and that's what's happened in silver. Silver spiked up to about 120 an ounce. It's now at 80. And that's what happens. I mean, when you have these large bull markets, that is totally normal, but it freaks people out. And it freaks people out, especially the short-term people. The people who are saying, oh, I'm going to go in and, and in a month I'm going to make 30% return and then I'm going to get out. Yeah, those kinds of people, they get killed in these kinds of markets. So what I would say is, depending on your risk tolerance, that's a huge disclaimer I have to put out here. If you are someone who is more risk oriented, you don't mind seeing your portfolio down 20, 30, 40%, as long as you're confident in the long-term growth of the portfolio, then, gold and silver spot is a decent play. If you really are okay with risk, then I would be looking at gold and silver miners and streamers, because those in theory should give you a much higher leverage on the price of gold, as I just discussed. And of course, what you're looking for on those kinds of companies is, what I would recommend for the vast majority of people is just go with a mining fund, right? That kind of has a smattering of different miners. It's very difficult unless you know the mining industry exceptionally well, which 99.99% of people don't. then I would be very wary of just jumping into individual stocks, because obviously each individual company has a different slew of difficulties, political jurisdictions, right? That's one of the major dangers with mining stocks is most mines are in, countries like Nicaragua and Peru and Kazakhstan, and jurisdictions that can be risky, obviously. So what I would suggest for most people, if you have the risk tolerance for metals, is, tend to just look at ETFs, just baskets of miners. But where I think it's going, to answer your question and like leave this in a concrete manner, is I long term, I think they are absolutely going up. I don't think there's anything long term that can stop it. Short term, that's much more difficult to say. Honestly, with the silver price for 2026, I don't know. I don't know if it's going to explode, or it's going to plummet another 20 or $30 an ounce, or just consolidate. Up till now, it's been consolidating, but the short term is very tough, very tough. And I don't think most people should be trading on a short term. I think most people should be having a 10, 15, 20-year time horizon. And in that time horizon, I am very, very confident that the price of gold and silver, given the dynamics I've laid out, it's hard to see how those prices do anything but go up.
Yeah. That's interesting. We were talking before we jumped on here about some other sectors in the market, and what are some that interest you, or where do you think there's some opportunities?
Yeah. So, and this I think will be a little bit quicker because it is somewhat related. I think copper, for example, is a very interesting and compelling market right now. And again, first of all, in general, and this is very much a me kind of investment philosophy, what I gravitate towards are the investments that are hated, unloved, or overlooked. Those are the sectors I like. I get very wary of investments when, everyone's talking about how great it is, and, everyone on the streets talking. That makes me nervous, right? Yeah. When people are just, for example, when Bitcoin was getting really frothy years ago, and it was at 120,000 a Bitcoin, and everyone was talking about Bitcoin. Oh, that stuff makes me very, very, very nervous, because that's typically, it just seems to be a law of the market that when the crowd crowds into a trade, it stops being very compelling. So copper is one of those sectors that is very much overlooked. Most people don't think about it. But what I'll mention on copper is, first of all, it's somewhat related to gold and silver, because a lot of the mining companies in gold and silver, they also mine copper, which when you think about it is kind of obvious, right? I mean, when you dig into a project, you're not, it's not typically just gold. You're probably going to find other metals there. And so there are many copper miners who are mainly copper miners, and they also, have an allocation or they have some production in gold and silver, and vice versa. But what's interesting about copper is this really ties into AI, and in particular, the amount of electricity that we need to generate. An interesting little factoid about the copper market is that by very compelling studies and numbers that we have, we need about a $250 billion investment in copper just to meet demand, current demand in electricity. And the problem, and of course, what's the problem with that? Well, the problem is it takes 10 to 15 years to build out a copper mine, and start getting output from it. So that's what we would call a structural deficit, which means so in other words, and I think almost everyone watching this will know at least enough about economics to know that if my supply stays exactly the same and there's no way I can create more of something, but the demand absolutely explodes, well, what's going to happen to the price? It's going to go up. I mean, it has to. It's an ironclad law of economics. And those conditions are very much met for copper. Copper, by the way, is pretty much at all-time highs currently, over $5. And there's mathematically almost no way in the long run. Again, I'm speaking in the long run because, of course, copper is very much cyclical in that it is tied to economic growth. So when we have recessions or depressions, the price of copper typically tends to implode because, of course, what is copper used for? It's used for infrastructure. It's used for electrical wiring, energy production. And so obviously in a recession, when there's less economic activity, there's less need for energy of all kinds. And so the price, collapses. So, if we were to get a recession, which we very well might, especially given the Iran situation, we can talk about in a second. In the short term, copper, of course, could correct, and it could correct down hard. But the math of the medium to long term is such that if you have a $250 billion structural deficit, it's hard to see where the price could go in the long run, again, other than up. And as it goes up, these copper mining companies are also going to explode in value. So copper mining companies are also and streamers are also, I think, a compelling investment. That's kind of the copper side. Another one where we have a very, very similar situation is uranium. And talk about a sector that is even less thought of than copper. I mean, nobody thinks about uranium except for, I guess, nerds like me. Aside from that, very, very few people think about uranium. But in uranium, we have an even worse structural deficit than copper. So with uranium miners, for example, we currently have enough uranium production in the world to meet the current nuclear demands of no more than 80%. Okay, so let's think about this for a second. Even with the current reactors we can only meet 80% of the demand currently. And again, uranium is subject to the same logistical constraints as copper. You can't just flip a switch and create and produce more uranium. You have to, build a mine. You have to design it. You have to get the permits. You have to build it out. It's going to take minimum, bare minimum. It's going to take 5 to 6 years to start flipping on uranium production. But there's another aspect to this that makes this even more interesting, and that is, and this is my belief. I wager that, and I do have some evidence for this. I think nuclear power is going to make a comeback in the United States. And in fact, I was just reading, I think this happened a couple days ago. This is very recent, but a small nuclear reactor, which is the new generation of, they're very small, compact nuclear reactors, was just approved in the United States for the first time. So a nuclear reactor was just approved in the United States for the first time in, can't think off the top of my head how long, but many decades. And of course, if we look at, for example, Europe is a disaster. I mean, Europe's an absolute disaster energy-wise. They are actually deindustrializing. And what I mean by that is energy has become so expensive in Europe because, of course, they're not getting Russian oil. They're getting U.S. Gas, but of course, there's no pipelines for that. That has to be shipped over there, which is more costly, of course. And Europe has such an energy problem that their economy is just teetering at all times on recession. Arguably, it is in recession. I mean, Germany has had multiple negative GDP prints. And when I say deindustrializing, I mean factories are closing down and businesses are just giving up because the price of energy is just exceptionally ridiculous. And it seems to me that the only path forward, if Europe is just insistent that they don't want to rely on quote unquote fossil fuels, if they just really insist that be the case, well, what options do you have? I mean, they've tried solar, they've tried wind, it's just not cutting it for them. So what do you have? Nuclear. I mean, you're getting to a point where that's all you got. Which would make sense because Europe has a history with nuclear power. It wouldn't. I don't think it would be particularly controversial for them to start approving new reactors. And if that happens, think about everything I just said till now. A current structural deficit on existing nuclear power, and then what happens if we start building a bunch of new nuclear reactors? I mean, the price of uranium goes ballistic. And again, these uranium miners are going to absolutely make a killing.
Very interesting.
And I guess, and I'll just touch on this briefly, go on maybe 2 or 3 more sectors that I think are interesting and are worth thinking about, right? Maybe including some of those ETFs in your portfolio, considering it, if you have the risk tolerance for it. One thing I would mention as well is Chinese AI. You know, we've been talking about AI. I've mentioned it briefly. AI is a big subject. And one of the reasons that it is a large subject is because AI has a voracious appetite for energy. And that will continue to be the case. I mean, currently, there are multiple numbers out there that we are going to need to spend in the United States $600 billion in capital expenditures for AI per year. 600 billion. I mean, it's an unfathomable number. And again, that's part of the reason why I am so bullish on kind of these commodity stocks. But what is the issue I see with this? And I'm not sure this is going to be particularly, insightful. That's why I'll mention it very quickly. I think there's a lot of people that would agree with me on this, which is that American AI companies the costs are astronomical to be able to process these AI requests, right? To generate these chats. And the problem I see with that is that eventually these American AI companies are going to have to make a profit. How are you going to make a profit with $600 billion a year? A lot of people think that there's a way to it. I'm sure maybe in the long run, maybe there is. But here's the fundamental issue: Chinese AI companies are almost as good. I mean, there are multiple benchmarks out there. You can look it up, but there are multiple benchmarks out there talking about comparing Chinese AI to American AI, and the abilities are very similar. Most people would say, it seems to be the consensus, that Chinese AI is not quite as good as American AI, but it's pretty close. But here's the kicker: Chinese AI is 1/30 the cost. That's the kicker. And so in other words, I'm worried with American AI about the sustainability of the share price when your competitor is making an almost as good product at 1/30 of the cost. That's very concerning to me. And what's more, if I'm an investor and I really like AI, well, the obvious consideration, I think, is, what about these Chinese AI companies? Their price to earnings ratios are far lower. I mean, in the Chinese AI space, there are companies with price to earnings ratios as low as 17, whereas in the American AI world, companies are regularly anywhere from 30 to 50. So, think about that for a second. These Chinese AI companies are almost half the cost. So now, of course, one of the reasons that is what somebody listening to this might say is, well, yeah, but it's China. So there's a bunch of risks that American AI companies, aren't subject to. And I would agree. But I would say maybe our disagreement would be on how risky that is. What is the risk with Chinese AI companies? Well, the risk is you can't directly own them if you're a U.S. citizen. You basically have to, you can buy them on U.S. stock exchange, but you're not really buying the stock, you're buying a derivative of the stock. And so at any time, China could basically say, okay, we're delisting you. And, your stock holdings would essentially plummet to basically zero. That's a risk. Could happen. Is that worth half Is that worth an equity at half the cost or half the price of an American equity? I don't know. I don't think so. I don't think China really has a vested interest in delisting it. I think the only real risk would be obviously an armed conflict with. I think they would delist those companies if China went to war with the U.S. Of course, but my counter argument to that would be if the U.S. and China has a war, then everyone's portfolios blow up, and perhaps the world. So, we have a whole new slew of risks if China and the U.S. go to war beyond just delisting of some stocks. And then I guess the last sector I would mention, but it is tricky. It wasn't tricky a few months ago, but it is tricky now. And that is, I've been a huge fan of the oil sector. I thought this year was going to be a very good year for oil. It has. That it has done. Didn't happen exactly. I thought it would be more because of the fundamentals, but of course, this Iran war definitely helps the oil price, unfortunately. So, but even on oil, again, we are subject to the same constraints. There's chronic underinvestment in the oil sector. Unfortunately, because of what's happening right now, I think oil, for the time being, is pretty much uninvestable. I don't think, unless you're a pure speculator and you're just purely gambling on news headlines, I couldn't recommend to my clients that they, buy anything touching oil right this second, because we're just going to have to see how this Iran war plays out. But those are some sectors that I'm excited about, and I think there's opportunity, and I think people should maybe look into a little bit more.
Yeah, that's very interesting, and thinking about how, anytime that there's a stock that anybody talks about, I'm that person that's messed it up and been like, I'm going to put in some money here. And then it's like, well, so did every Joe Smo. And now it's no longer.
And that's the thing. And that's the thing. By the time everyone else has put money into it, generally, not always, but generally, it's too late.
Yeah. Yeah. So how would you describe to, the average person then, how should they approach wealth accumulation? So like, you made a comment, like the 10 to 15, 20 years, if you're okay with that, then you're in a good spot. Is that kind of your forecast basically?
Well, so to wealth accumulation in general, you need to be very disciplined in how you look at it. So, and it typically is a boring, unfortunately, it can be a boring discussion a little bit, because what everyone needs to understand, everybody, no matter if you're, making $50,000 a year or $1 million a year, somewhere in between, you have to methodically look at wealth accumulation. And the first part of that is protecting your wealth. Okay. Here we are talking about, stocks and the price of gold and silver and yada, yada, all this exciting stuff. But here's the reality. If you have no money to invest, then it doesn't matter. All this stuff we're talking about is just entertainment. There's nothing actionable you can really do. So the first step people need to do, and we see this all the time at Opus One. All the time, almost always when we talk to a new client, they haven't protected their income. They don't have disability insurance. They don't have life insurance. They don't have an emergency fund. And that's a real problem, because if you have set up an entire investment plan, and then you pass away or you become disabled and you can't work, well, there goes. And unless you inherit money or are gifted money, where are you going to get the money to invest? So the number one thing that people have to do, and unfortunately it's not very sexy, but the first thing people need to do is make sure that they've protected their income. Okay, and that's one of the things at Opus One we really specialize in doing. Make sure you protect the income, such that no matter what life throws at you, you can fulfill your investment plan. Even if you pass away, but if you have proper life insurance planning, well, your family's going to have the funds to be able to continue with the investment plan as laid out. If you have that disability policy and you can't work anymore, or you can't make as much money anymore because of, some kind of disability, you'll be able to have the funds to continue with the investment plan. So that's step number one. And people really need to take care of that stuff, because almost always what happens is people jump immediately to, how do I invest? Okay. And that's cool. That's all great. I love it. As you can tell, I love talking about it, but you got to make sure you protect the income first. So that's number one. Number two, you need to focus on tax planning and estate planning. Okay. Because the biggest eroder of wealth are taxes. And often estate difficulties, whether it be, estate tax if you're a high net worth person, or, just the fact that you didn't allocate your assets properly to your heirs, which causes problems for them later on. So tax planning, estate planning, make sure you're, talking to CPA, a financial advisor, right? But just making sure everything aligns. Everything needs to align. Your income protection needs to align, and it needs to tie in to your tax planning to be able to pay the look. The reality is with taxes is you are only required to pay what you're required to pay. But oftentimes the majority of people, and there's actually good statistics behind this, the majority of people actually overpay on tax because they don't take advantage of the deductions and the credits offered to them. So that is probably the single biggest return on investment you can get, is making sure that you have a solid tax plan and are being as efficient as possible with your taxes. And then tying that all in with your estate planning. So that's number one. Make sure you have income protection, optimize your tax plan, optimize your estate plan. Once all of that is tied together and it has a coherent structure, now we can really get into investments, because at that point you're protected. And now we can talk about an investment strategy that's actually going to build wealth over time. So, and at that point, the general rule of thumb is think long-term. Investment, when you invest for the long term. Okay. So many people get greedy, and they think they're market timing wizards. And I'm not sure anybody's a market timing wizard. I mean, if you're an insider trader, maybe, but now you're breaking the law. So, but for just normal people, like you or I, it's very tough to time the market. And so I don't even really try. And by timing the market, I mean like, oh, next week, gold's going to do this. I don't know what gold's going to do next week. I have no idea. And guess what? You don't either. I mean, nobody does. So, but in the long term, the fundamentals will win out, and the investments will bear its fruit. But you have to think long term. Yeah.
And how does being high net worth change the accumulation of wealth?
It changes it. It can change it quite a bit. So for the average person, for example, the average, for most people who are just earning a living and they don't ever really have to worry about, for example, the estate tax. The estate tax is a 40% federal tax on everything above around 34, 35 million for a married couple. And of course, the reason most people don't have to think about that is, well, most people don't die with over $35 million of assets. So, that 40% tax, right. So that 40% tax, it doesn't enter the brain, the minds of most people, and it doesn't need to. But if you're high net worth, it does. It does, because, obviously, just crunch some quick numbers here. If you're worth $100 million and you pass away, and it's 40% above 35 million, that's a pretty juicy number. And then it gets even worse, because most people who are high net worth, the reason they're high net worth is because they have lots of assets. They could have lots of real estate. So let me give you just an example. Let's say you have a small real estate empire. All right, you're worth $100 million, but a lot of that wealth is, a good $50 or $60 million of that net worth is in real estate. Well, what's the problem if you pass away and now you get hit with a, let's call it a $30 million estate tax? And now what do your heirs have to do? Well, if it's all in real estate, you got 9 months to pay that estate tax bill. So they've got 9 months to pay 30 million.
Oh.
And let's say you weren't very liquid. Now what do they have to do with all that real estate? Well, now they're going to have to fire sale it, because the reality is oftentimes you're not going to be able to sell real estate in under 9 months unless you drop the price down massively. And so it may end up being the case that you have to sell off 40 or $50 million of assets in order to satisfy a $30 million estate tax bill. So that's quite an issue.
Yeah.
And so that's why, especially, and then probably the worst part about it is, again, using my example, it's one of those things that you have to prepare for years in advance. If you if you're on your deathbed and now you're like, oh crap, my heirs are gonna have to pay a huge tax bill. Well, at that point, it's probably too late. Not much you can do. So unfortunately, it's one of those things that you need to take care of well in advance. And unfortunately, a lot of people don't want to deal with it because, again, it's not as exciting as, if you're a real estate investor, you want to go out and you want to wheel and deal and talk about real estate. It's not the funnest thing in the world to talk with a financial advisor and a lawyer about estate planning, but you just have to just realize that it needs to be done because it can save you multiple millions of dollars, multiple, just a few hours of work, so to speak, has humongous ROI. And that's what you have to think about. And so for wealthier people, look, the reality is when you become wealthy, your job becomes managing your money. And I think if I had to boil it down, to give a concise answer to your question, that's really what it boils down to. That's the main difference between someone who's just, has a successful life, but they're worth they're retired, they're worth 1 or 2 or 3 million. And I'm not looking down at that at all. I'm just, you live life, you can relax, you get Social Security, but when you're worth 50, 100, 200 million, your job, you never retire. Your job becomes managing the money. And as such, you need to treat it as the job that it is and make sure that you have plans in place to protect those funds.
Yeah, I mean, this is also interesting. I think we could probably talk for another 2 to 3 hours about all of this, but we're right at about an hour. So I think that this is a good time for us to kind of, hey, if anybody has any questions, I mean, you can always reach out to Troy. Thank you, Troy. You are so, honestly, this hour flew by because I was so engaged with what you were talking about. So I do think that a lot of people need to learn more about this. And so I would love for us to do more of these with you. So thank you so much for doing this and sharing your insights with us today. Overall, Opus One's mission is to help individuals and families build long-term financial confidence. And that's through the education. I'm already way more educated in this hour than I was before I started. So education, the planning, personalized guidance for everyone who joined us today. If it sparked any questions about your own financial strategy, we encourage you to reach out to Troy. All the information's right there on the screen. You can give him a call, send him an email. Please feel free to do that. Thank you so much for spending the time with us today. I hope that you found this discussion as valuable as I did. And we look forward to seeing all of you and connecting with all of you again soon. So thank you again, Troy, Chelsea. This was awesome.
Thank you, Kaylee. Thank you, Chelsea. It was a lot of fun. We'll have to do it again.